Hello good people, welcome to financial accounting. Today we are looking at the section B questions. We are going to look at the statement of cash flows, or say cash flow statements. Right, so on the cash flow statements we do have three headings. We have the operating activities, we have the investing activities, and the financing activities. Guys, most people, they are worried about the cash flow statement. They say that they are difficult, we won't be able to remember a lot of things. This is what I want to tell you guys. If you're doing FA financial accounting, the format will be there in the exam. It will be given. So you just need to know few workings. We know how to prepare the taxation account, know how to prepare the PPE account, know how to prepare the retained earnings account. So it's just a matter of adding and subtracting. The format will be there. Right. So let's look at this question. Kraker Kaplan. I'm using Kaplan exam kits. Kraker Kaplan. Page 144. Page 144. This is the question number 7. Kraker Kaplan. So let's hammer this question. In other words, let's crack it. Right. Let's crack the question. Right, Kraker Kaplan, this is the profit or loss. You'll be given the profit or loss in the exam. So this is the profit or loss. They made a profit of 8750, and there are 3 zeros on the top. That's fine. Looking at the financial position, there are 3 zeros on the top. That's 2000 and 2001. The prior year and the current year. Right, that's fine. We have the additional information. This is the additional information. If you look at these amounts are not recorded there in the statement. So when you want to record them, since this is the additional information, you'll be removing 3 zeros, right? So required, what are you required to do using the information available? Complete the statement of cash flows for Kraker for the year ended 31 March 2001 in accordance with the International Accounting Standard number 7. So this is what I was saying. The format will be there in the exam. So guys, do not claim, do not be worried about the format. Operating activities. So it's just a matter of recording the amount. If it's positive, it's 10,000, you record 10,000. If it's negative, you record negative 10,000. You understand? So the format will be there. So guys, do not be worried about the format or what. Right, so let's look at this. So I'm not going to use the format, I'm just going to do the calculations without following that format. Right, so we'll start with the operating activities. Okay, before I do that, you'll be given theory questions in the exam where they will say, which of the following things are recorded in the cash flows, or which of the following should not be recorded in the cash flows. Right, if it's theory, guys, just know the statement of cash flows. Cash flows. We are talking about the movement of cash here. So if there is a cash inflow, if you receive cash, you record in the cash flows. If there is a cash outflow, you also record in the cash flows. As long as there is movement of cash, it should be recorded in the cash flows. So which means non-cash flow items should not be recorded in the cash flows because it's not cash. For example, depreciation, guys, depreciation is the loss of value of an asset, but it's not cash. So if your cash, if your asset is losing value, in the accounting terminology, we'll be saying it is depreciating. So the depreciation is not cash, therefore it should not be recorded in the cash flows. For example, guys, I always tell people that a phone, a smartphone, the phone that you use, it's what? It's an asset because it's giving you benefits. But every day you are using it, every day it's losing value. So will you say that there is outflow of cash? Are you losing $1 every day? Are you losing $2 every day, or even $5 because you are using your phone? No, there is no movement of cash, but the asset is losing value. You agree with me? Therefore, depreciation is a non-cash flow item. It should not be recorded in the cash flows. Right. So non-cash flow items, depreciation must not be recorded. Profit or loss on disposal, must not be recorded. Because if you dispose of assets, you can make a profit, you can make a loss, but the profit is not cash. Yes, you agree with me, right? You have your asset. Maybe let's say you buy you buy something that is worth $10 and you decide to sell it at 15. The amount that you receive, the cash that you have is 15, but you'll be saying I made a profit of 5. Yes, you made a profit of 5, but the cash that you've received is 15. I think that profit and cash, these are two different things. So it's a non-cash flow items, it's not cash. Number 3, if there is a bonus issue. If there is a bonus issue, remember on bonus issue we say when additional shares are issued. So the issue of new shares to the existing shareholders at free of charge. You have not received cash. You understand? Bonus issue mostly is made when a company fails to pay dividends. You don't have cash to pay shareholders. So you can give them additional shares. So this is not cash. So therefore, it's a non-cash flow item. Right. So now let's look at the question cracker, cash flows. Why do we prepare cash flow statements? Let's look at the financial position. Financial position. Are you seeing this? We have cash and cash equivalents. Right. The reason why we prepare the cash flows, we want to provide evidence, or we want to prove how our cash balance has moved from this to this. Looking at 2002, the cash and cash equivalents balance, it was 1,250,000. There are 3 zeros on the top. Looking at 2001, the cash balance is now 4,250,000. So just imagine, guys, we do have different users of financial statements. They don't just believe information at face value. By just looking at, okay, your cash balance, it was 1 million something, okay, it's now 4,250,000. Oh, you're performing well, so your liquidity is improving. Don't just believe information at face value. Show us how the cash balance has moved from 1,250,000 to 4,250,000. So guys, if you look at this, the cash balance has increased by how much? It has increased by 3 million. So it has increased by 3 million. So the increase is 3 million. So this is the increase. It has increased by 3 million. So we want to prove how it has increased by 3 million. So we'll start with number 1, operating activities. Operating activities. 3 zeros on the top, you copy as it is. Right. So as I said, the format will be there. So do not be worried about cramming. So allow me to write profit before tax. Allow me to add back interest payable. Allow me to also less back the interest received, or I call it investment income. Yes, on this one, yes, that's it. So on the question, we'll start with the profit before tax. What's profit before tax? This is 11,650. Right. Now we want to do a backwards. Profit before tax, this is 11,650. Guys, what we want is the profit, not just before tax, but before the interest and the tax as well. So let's go backwards to get the profit before tax, before we accounted for the tax, for the interest. If you look at this, I want to go back. This is the interest payable. And also the investment income is also the interest. Because when you invest your money, you get an income, an interest. So I want a profit before these two, before these interests. So I will do a backward working. So guys, the word backward means you'll be doing vice versa. So this is 11,650. The interest payable, they did less. So since I'm going backwards, I will do opposite, I'll add. The investment income is positive, they did add. So since I'm working backwards, I have to deduct. So allow me to add this into less this. Right, so I'll add the 2150 and less the 320. As I said, do not be worried about the format to be given. Right, doing the number crunching exercise here, I'm getting 13,480. Then the non-cash flow items. Non-cash flow items, remember what I said? Non-cash flow items, we have the depreciation. And we also have the profit on disposal. It can be a loss or it can be a profit. But on this question, we have a profit. Let's go on the additional information. Additional information, we have two additional information. Let's read it. During the year ended 31 March 2001, Cracker Company disposed of some items of plant and equipment. The carrying amount of these items was 800,000. The depreciation charge for the year is 500,000. These are the amounts that are not in the statements. And if you look at your statements, they have 3 zeros on the top. So the additional information, the amounts are in full. So when you want to also record them in the statements, you remove the 3 zeros. So the depreciation is 500 here. Right. So this is a non-cash flow item. So guys, remember what we said. We do not record the non-cash flow items in the cash flow. Here we are not recording them. We are reversing since they were recorded before. The non-cash flow items, these two, they were recorded in the profit or loss and they affected this balance. So we want to reverse, not that we are recording. We are reversing, guys. We are reversing. So you ask yourself a question that depreciation, it was recorded and it did affect our profit. In the profit or loss, this was treated as a negative. It was deducted. So it did reduce our profit. So now, since we are reversing it, I will add it here. 500. It's 500,000 and there are 3 zeros. So I will remove 3 zeros since it's additional information. I'll record 500. What about the profit on disposal? On additional information, they didn't tell you about the profit that was made. So normally we calculate, if you are given on note 1, you compare the sale proceeds and the carrying amount. But on this question, we are not given. So you can even go to the profit or loss to see if the profit is there. Get to the profit or loss. I'm seeing the profit on disposal there. The profit on disposal of 300. In the profit or loss, it was added. But guys, we've agreed that this is not cash. Let's reverse it. So since it was added, I will deduct it. I will deduct it. I will deduct the 300. Right. Now, let me just do the working capital changes. Working capital changes, guys. Right. The working capital changes, let's go to financial position. Working capital changes, guys, we need the current assets and the current liabilities. Right. Now, on the current assets, we only need inventory and the receivables. And on the current liabilities, I need payables. We need 3 things. So just look at the question. You look at your inventory. Did your inventory increase or decrease? So this is 2000 and this is 2001. If you look at this, this is the previous year, this is the current. So my inventory is increasing. My receivables is also increasing. So to save time, I'll just write increase in inventory. Increase in trade receivables, right? So the trade receivables, the inventory is increasing by how much? By 2,000, right? It is increasing by 2,000. So I'm just doing this to save time. Just write as it is. The receivables, 30,500 versus 33,000. It is increasing by 4.5. What about the payables? We go to the current liabilities. The payables, 31,900 versus 29,450. They are decreasing, right? So you just write decrease in trade payables. Guys, the trade payables, these are our suppliers, right? We owe them money, right? 24.50. Then after you do this to just save time, you then analyze. If it's an inflow, you add. If it's an outflow, you deduct. So looking at this, increase in inventory. My inventory is increasing. It means we paid. Because your stock is increasing, it means we are looking at the cash balance. Are we receiving the cash or we are paying cash? If my inventory increase, it means I've paid. I've acquired goods, in other words. I've acquired stock. So the cash is moving out, outflow. Increase in trade receivables. Most people, they are confused now on the trade receivables. The trade receivables, these are the customers who are buying goods on, so we are selling the goods to them on credit basis, right? So if the balance increase, it means they have not paid us money. They have not paid us. Just think of the opposite. Just think of the decrease in receivables. If the receivables decrease, it means that they have paid us money, it's an inflow. So meaning if they increase, it's not an inflow, it's an outflow. If the receivables increase, they are not paying us money. They are keep on getting goods on credit. You understand? Remember the concept, the time value of money. The dollar received today is worth more than the dollar received tomorrow. Imagine if someone owes you now maybe, let's say 10,000 RTGS, 10,000 bond, right? Then the person will say, I'll pay you next year. So are you seeing that you get less? Because the money will be losing value with time. So they are not paying us. So to us, it will be an outflow. So this will be in brackets. The payables, they've decreased. The payables are the suppliers. Last year, we were owing them this amount. This year, the balance that we owe them, it has decreased. It means we have what? Paid the cash. Since it's an outflow of cash, this will be in what? In brackets. So now I'll add this. 13,480 plus 500 less 300 less 2,000 less 4.5 less 2450. So I'm getting 4730 here. Right. 4730. So guys, I want you to understand this balance. This was profit before tax. And since we did add back, what's this amount? This amount is profit before you have paid what? For your interest and for your tax, right? So now let's pay that interest and the tax now. So let's the interest paid. You also less the tax paid. Now, you go to your current liabilities. What do we have on current liabilities? I'm seeing the payables and the tax. We don't have the interest payable on the current. So therefore, this doesn't need an account. For the interest paid, this is the interest payable, 2150. So let's now pay it. Understand? 2150, you pay the interest. What about the tax? Now the tax needs an account. This will be my working one. this will be in brackets because I'm paying tax. So what about tax? Let's do a working need space here. So let me just move this. We are still on operating that. Let me open the account here. Taxation account, guys. Taxation account. The debit, the credit, right? Tax is the what? It's under current liabilities. All liabilities are represented by a credit balance. You understand? They have a credit balance. So the BD, it will be on the credit, like the balance that we owe them in the last year. So if you look at this, what is the balance? The tax is 2310 for the prior year. For this year, is 2.9. You close off. You close off. This is what I want you to understand. Let's go to the additional information. Do we have the tax? Yes. On second note, Cracker Company estimated that the income tax liability arising on the profit for the year is 2.9. So you were estimating to pay this amount. Was it the amount that we actually charged? You can go to profit or loss. Let's go to profit or loss on income tax. Less income tax 2.9. Yes, this is the amount that we actually charged. So you take this one in the profit or loss, the amount that was charged. So profit or loss charge. We were charged 2.9. So guys, taxation, we owe the tax authorities. BD, this is the balance that relates to the previous year. Last year, you were owing them this amount. This year, you were charged this amount. So guys, the total amount that you be owing in total, it was supposed to be 5210. It was supposed to be 5210, guys. I'm saying last year we had an owing of this. This year we were charged 2.9. So the balance was supposed to be this. It was supposed to be this. But if you look at your CD is the balance that you are now owing them. But it was supposed to be this, but the CD, the balance is now 2.9. So what does this mean?
Wait.
Yes, we paid the difference. So what's the difference? Is 2310. So the tax paid is the difference is 2310. So we paid 2310 here. We paid 2310. So if you sum up, if you less all these amounts, you get 270. So this is the operating activities. We are done with the operating activities.